The market just closed the week at an all-time high, and the reason it got there should make you sit up. The Dow set a record on Thursday, not on strength, but on a weak jobs report. Half the hiring Wall Street expected, and the crowd cheered, because bad news for workers is good news for rate cuts. But underneath that green headline, the chips just had their worst 2 days in months. And the loudest bear in the market is calling the whole artificial intelligence trade an addiction. This is a brief about the gap between the number that gets claimed and the number that's actually on the receipt. Here's your full picture in about 5 minutes. First, the board frozen at Thursday's close. The Dow 52,900 up 1.14%, an all-time high. The S&P 7,483 dead flat, torn between the two tapes. The Nasdaq down 0.8% on a brutal chip sell-off. Gold around 4,187 an ounce, bid on a soft dollar. Bitcoin firm near 62,000, up 7% in 48 hours. The 10-year eased to 4.40, and the dollar had its worst week since April. Oil, $70, calm, one word for this tape, divided. Every asset here is trading one story, an easier Federal Reserve. Now the reads where we part ways with the crowd. Read 1. Everyone sees the all-time high and says the bull market is healthy. Here's the tell. The Dow set that record on the very same day the Nasdaq fell and the S&P closed flat. The record lives in 30 industrial stocks. The growth names and the chips got sold. And remember what fueled it, a weak jobs print. A high that only the narrowest index can confirm, powered by a cooling labor market, is not a breakout. It's a rotation wearing a breakout's clothes. Bad is good works right up until bad is just bad. Follow the money and it all traces to one number. June payrolls, 57,000 jobs against about 115,000 expected, the weakest in 4 months, and the 2 prior months were revised down by 74,000 combined. Unemployment actually fell to 4.2%, but that's the deceptive kind of good. It fell because people left the workforce, not because they found jobs. Participation dropped to the lowest since 2021. The market cheered anyway, because a cooling labor market pins the Federal Reserve to cuts. But labor is now cooling faster than inflation is falling. That's a yellow flag dressed up as good news. And watch how everything lines up. Weak jobs, rate cut bets, the 10-year easing, the dollar sliding to its worst week since April, and gold catching a bid back to 41.87. But be precise about gold. That's a bounce off a 4-week decline and a soft dollar, not a fierce spike, and it is not a record. Underneath it all sits the fiscal picture, and here's the receipt that matters. The government efficiency effort, DOGE, expired on July 4th, having claimed about $160 billion in savings, against an original goal of $1 to $2 trillion. Independent analysts can only document a fraction of even that. The promised structural cut never came. Deficits stay elevated, and that entrenched backdrop is the slow, structural bid under gold. Read 2. Everyone in crypto is waiting on the Clarity Act, the market structure bill that's supposed to light the fuse. Here's the tell. That bill just missed its July 4th deadline, and its odds of becoming law this year have fallen to around 40%. And yet Bitcoin ripped from 57,700 to 62,000 anyway. What moved it wasn't legislation. It was the same weak jobs print knocking the dollar down. Near term, crypto isn't a policy trade. It's a dollar trade in a leveraged wrapper. The legislative catalyst is real, but it's later, and reading this week's pop as a clarity bid is reading the wrong receipt. Now the sentiment check from our market and social sentiment monitoring. The finance commentary world is almost unanimously cautious. Sell the artificial intelligence trade, rotate to gold, brace for a bubble. Meanwhile, the crypto-native side is leaning the other way, quietly bullish, precisely because everyone else is short, jaded, or sidelined. 2 camps, maximum conviction, pointed in opposite directions. When it looks like this, somebody is about to be very wrong. And that gap is where the edge lies. The tell of the weekend, and it is not a stock price, $725 billion. That's what the 4 biggest technology companies will spend on artificial intelligence infrastructure this year, up 77%, heading past $1 trillion next year. Against all that spending, the actual artificial intelligence revenue being booked back is a sliver by comparison. For 2 years, the market treated spending and winning as the same thing. On Thursday, for the first time, it treated them as different questions and the chips repriced. Frankie has the full breakdown in today's focus, linked below. Sectors in play. In the chips, the sort that matters is content versus capacity. Memory and testing, the content that grows as chips get harder to build, is a completely different business from renting out commodity computing, which is where any glut lands first. In metals, gold's bid is real, but gold over technology is now the crowded hedge, and a crowded hedge is a compressed edge. And in crypto, watch the plumbing, not the price. The prediction market venue, Kalshi, booked roughly 5 times the fees of its bigger-name rival last month. The structural money is in rails and unit economics, not memecoin beta. On the radar into Monday's reopen. First, the reopen itself, the first real reaction to the jobs miss. Does bad is good hold, or does the thin breadth finally crack into a growth scare? Second, the chips, a bounce or a third straight down day, which tells you whether Thursday was a rotation or a top. Watch the news that a top memory supplier is planning a United States listing. Then the Federal Reserve injecting about $10 billion in Treasury bills this week. A quiet liquidity tailwind. And later this month, the June inflation print and the cloud giants' capital spending guides. Do they still spend into a sell-off? And the scorecard, because we put our calls on the record, dated and falsifiable. 3 today. 1. The record Dow is a rotation artifact, not a broad breakout, and it reframes as a growth scare within 2 quarters. We are wrong if payrolls re-accelerate and breadth reclaims leadership. 2. The binding risk in the artificial intelligence trade is now the gap between capital spending and revenue, not regulation. We are wrong if a clear monetization inflection shows up in the next 2 earnings cycles. 3. Near-term crypto is a dollar trade, not a clarity trade. We are wrong if Bitcoin decouples upward while the dollar is rising. All 3 go in the ledger. So the bottom line, 3 stories today, a record index, a fiscal cleanup, an artificial intelligence boom. Each came with a confident number attached, and in each one the claimed number and the documented number were miles apart. A record only 30 stocks can vouch for. A $1 trillion promise that delivered a tenth of a rounding error. 3/4 of a trillion in spending against a sliver of revenue. Markets run on the claimed number right up until all at once. They demand the receipt. Thursday's chip tape was the first small demand. The only question is whether Monday brings more. Sit with that one. That's the brief. The full written breakdown and today's focus with Frankie are both linked below. I'm Earl. This is the asymmetric signal. 1 contrarian read a day. Subscribe.